Hi, this is Brett with Monarch Capital Home Loans, and today we want to talk real briefly about the economy and mortgage rates and how these things move together, because I think there's quite a bit of confusion about that. And what I want to do is just give you a real simple rule of thumb. I mean, we could get into a much more complicated explanation, but that's not the mission today. Basically, think first of all in terms of the stock market. So the Dow Jones, the NASDAQ, the S&P. Think in terms of those indexes, and basically mortgage rates are going to move roughly in response to the movements in the stock market. Frankly, if the stock market, generally speaking, is going way up, that generally means that you're going to have higher mortgage rates. And if the stock market is crashing, or not necessarily crashing, but if it's just going down, you're going to see lower mortgage rates. Again, the real quick reason for that is because institutions, governments, pension funds, there's lots of money and cash out there that's always looking for a good return. And when times are good, they're going to come out of fixed income instruments like bonds, which are what mortgages are structured from. And conversely, if they're not getting a good rate of return in the stock market, they're going to pile into those fixed income instruments, thus making mortgages more attractive to investors, and that makes mortgage rates lower. But irrespective of all the details behind that, the bottom line is if there's real exuberance in the market, you can look for higher mortgage rates, and if there's fear, mortgage rates will be going down. Now, one of the key signals that you can watch here is the 10-year Treasury yield. Now, there's some misunderstanding. People think that somehow mortgage rates are directly tied to the 10-year Treasury. That's not true. It's just that the 10-year Treasury is sort of a benchmark bond that kind of gives you an indication of what bonds in general are doing, particularly as it relates to 30-year fixed loans. And the reason for that is because most people don't stay in a 30-year fixed loan for 30 years. Most of them stay in for around 6 to 10 years. And so the duration of this bond, this government bond, is a good measure of what 30-year fixed rates are going to do. So you can go to cnnmoney.com, you can go to marketwatch.com, you can go to Yahoo or Bing, there's Google Finance, and you can watch that yield, and whether it's moving up and down typically tells you what's happening with long-term fixed rates as it relates to mortgages. Now, basically at the end of the day, then what's moving it? What's making the market move? It's basically fear or optimism about the future. If people think that the economy is going to grow and that times are good, stocks will rise, rates will rise. If there's fear and they think things are coming to an end and it's ugly and employment's going to be bad, then they want to protect their capital, protect their money. They're typically going to put it in fixed instrument kinds of bonds, and then you're going to see better mortgage rates. So how do you time this? Well, I think that, again, if you're not watching this every day, a good loan officer can kind of give you a point of view of what's been going on for the past several years or several months, even down to the last couple hours. But I would say that during this time, there's just no question that we're seeing unprecedented low rates over the course of really the last 50 years. And so while we may not right at this moment, as I sit here in the fall of 2013, being at the absolute lows of mortgage rates relative to what they were maybe this summer, or for example, the bottom line is it's a great time relative to the scope of our history as a nation in terms of good rates. So you really almost can't lose relative to the long haul. A lot of people still remember, rates in the high teens during the 80s and so forth. So right now with long-term rates in the 4s and still some ARMs in the 3s, it's a great time to buy real estate. It's a great time to refinance. If we can help you, please let us know. If you have more questions about this, we'll be glad to answer them. Take care.